Mind-blowing Forex truths. Today, we will be going over some of the topics that I wish I would have been taught as a retail trader when I first started trading. Some of the topics we will be going over today are very unique in ways that are not discussed amongst retail traders. I know a lot of people have come into this market, the Forex market, through network marketing, through different multi-level marketing companies that don't talk about these aspects of the market that I believe are very, very important and should be discussed. So, number one is session change manipulation and the manipulation of spread during session change. Session changeover can be seen on TradingView by clicking the time scale and then going to session breaks. They're indicated by these blue lines. And not every day there will be some type of manipulation, obviously. If it happened every day, it would be pretty obvious that this type of manipulation was occurring. But what you can see is that it does occur every once in a while, but it happens on different pairs on different days. So here we can see on GBP USD there was a 220 plus pip gap or jump, spike, fall, whatever you want to call it, a spike downward of 220 pips at exactly session changeover. Have you ever noticed your spreads on session changeover? How violent they change, how crazy they become, even if there is no manipulation like this, even when the market is still like this. There will be that spread, that manipulation of the spread. And on the GBP pairs especially, we know the spread can be very violent at times. And here we can see GBP USD before it fell, it was creating this high right here. Now just imagine at session changeover, the high was extended. This point here was apparently the highest point at session changeover. But we know the spread was obviously manipulated at that point. Let's say that it was maybe a 15 to 20 pip spread manipulation. Sometimes it's higher. Sometimes it's 30 pips, 30 plus pips during market open on a Sunday or a high impact news event. It all depends on your broker and basically how greedy your broker is at the time, or the liquidity at the time. Here we can see if it was a 10 pip spread, price would be at this area right here. If you bought, you would have bought at this area. You would have gotten filled right here with your spread. And you can see the market then came down, off of that high right here, created that new high, but remember you were filled in this area. As a 10, 15 pip spread, you were filled in this area, and you did not have a chance to get out at break even, or had a very small window of opportunity to get out at break even before the market completely reversed on you. So, session change manipulation. Let's go on a different pair, a more exotic pair, to see this manipulation occur more frequently. A lot of times, stop hunts will occur at session change manipulation. A lot of times, the GBP pairs will stop hunt the high or the low, or just spike in general. This was a 40 pip spike downward to the low of the day on USD TRY. US dollar versus the Turkish lira. So, gaps as well. Those are pretty obvious, kind of different. Here again, we can see that somewhat of a stop hunt to the low, or a stop hunt to the low right before session changeover. There's the low, that stop hunt to the low right before session changeover, and then that session changeover, they come up, and then that session changeover volatility or spread is still occurring because it's only 15 minutes after the fact. They spike the low once more, open the spread completely, grab all the orders down here as well, and then just need to take off a little bit to blow some accounts. Here once again, just that session changeover manipulation, you guys. That spike, those spikes, and then you add the spread onto that spike, and there's obviously going to be a massive amount of liquidity that is unseen but has been sucked up through that manipulation occurring. So, GBP USD, I'm trying to get back to my thing here. Okay, spread manipulation, like I talked about, the spread. Brokers, a lot of brokers claim that they have a variable spread, but it's as low as like 2 or 3 pips, as low as 0.3 pips. They boast about these insanely tight spreads, but when you really look at it, these are spreads that have been averaged throughout the day. So let's take an average day. An average day has a high and a low, right? One high and one low. The rest of the day is consolidation, basically, or whipsaw, where they don't really need to manipulate the spread in here. Where do they manipulate the spread? Not in here, not in here, not in here. They manipulate the spread right here for a very short amount of time. Also at the low here, manipulate the spread, very short amount of time. What this does, even if you had, let's say you had 0 pips of spread, 0 to 1 pip of spread throughout this entire area right here. This consolidation area consisted of 0 to 1 pips of spread. This consolidation area as well, 0 to 1 pips of spread. This whipsaw area as well, 0 to 1 pips of spread. The only time the spread is being manipulated is at the high and the low of the day. In this area, let's say you have a 10, 20, 30 pip spread. In this area as well, you have a 10, 20, 30 pip spread. Now some brokers have fixed spreads. I am using a fixed spread broker. My broker has a 3 pip fixed spread on GBP USD, which means they cannot manipulate the spread, so my spread is fixed at a 3 pip spread no matter what, which is good for me in certain circumstances because I like to trade the highs and the lows, and a lot of times, like I said, the highs and the lows, the spread is manipulated. But what I'm trying to prevail here is that in this time that it takes to manipulate the spread, let's say this was an hour and 15 minutes, here was an hour and 15 minutes, that's 2.5 hours of the spread being, let's say, 20 pips. Then you take the rest of the day, which is what, 22.5 hours, and that's at 0 to 1 pips. You average that out, and that's how you get the broker's average spread, and that's what they proclaim. Meanwhile, this is the most important time. This is the best entry time and the best exit time, or entry, exit, whatever. These are the best times of the market to trade, and if you're not using a variable spread market or a variable spread broker, if you are using a variable spread broker, if you are using a variable spread broker, you will get stopped out a lot of times or have a very large spread in this high and low area. So that's where the broker kind of gets you. They don't tell you that. They say they average the spread out, and then they tell you what they want to tell you. Oh, we have a spread that's an average of like 1 pip. Oh yeah, how much do you manipulate the spread at the highs and the lows? Oh, about 30 pips. Yeah, okay. So, spread manipulation indicators are after the fact. So, what does that mean? Price is moving, and then based off of an average movement in price, the indicator will move because of the movement of price. If price did not move, the indicator wouldn't move. Okay, if this line right here, if this red bar stopped moving, this indicator would stop calculating. You can see if this were to spike down right now, the indicator would lag and move maybe 30 seconds to a minute later because it doesn't update constantly. It can't keep up with price, and that's with every single indicator, you guys. What I want to you guys to learn is that you don't need indicators to trade. You just need to learn price action. So, our next mind-blowing fact or truth is that scalping pays the broker. Scalping, in my opinion, is the worst way to trade. It is the worst possible way to trade. You'll always be looking for entry possibilities because you're scalping. It's always available. And yet, a lot of times, a lot of scalpers that I know don't use stop loss. They don't have the risk-reward ratio that I would consider as optimal. They use a 1-to-1 risk-reward ratio, or a lot of times less than 1-to-1, and just rely on their strategy or their 80% win ratio to cover up the horrible negative win risk reward ratio that they're using. So your scalping pays the broker. What do I mean by that? Every time you place a trade, that trade, your commission and your spread is automatically paying the broker. Every time you open that trade, you're paying the broker. So a lot of companies that are a lot of companies and brokers have different strategies that involve scalping or that involve taking trades, or EAs in robots that involve taking trades at very high frequencies and basically paying the broker massive sums of money, and you ending up with 100 trades at the end of the day and barely breaking even or barely breaking positive, yet having 100 trades. What if you could learn to take one trade and be up 20%, 30%, 50% on your account while maintaining a 1 to 5 risk reward ratio? That's what we're trying to obtain here at Forex Investors Alliance, and that's what we teach. So, scalping pays the broker. I could go on and on about all of this stuff, you guys, but I'm trying to make the video as short as possible. Brokers or marketers. So, the average Forex trader, the average retail trader, blows their account within 90 days. So, the broker, knowing this, will constantly have to be marketing his or her broker. In other words, have IBs, or independent brokers, or independent business operators. Brokers are set up in the exact same way as network marketing is set up. They have, I mean, it's not exactly the same, but it's very similar. They have people working for them and advertising their company for them, not knowing the insider facts of what's really going on, and knowing that your client will most likely blow his account within 90 days, you will need to constantly be obtaining new clients every 90 days. That's why the brokers have to constantly be marketing to their different clients through different outlets like Facebook, like YouTube ads. You've seen on the sides, probably on this video, to the right or to the left, you'll have a broker ad or something like that, you know. They have to be constantly marketing to keep up, to stay in business. And how do they get the money to market? Well, not only do they get money through the spread and the commission that is automatically deducted from your account upon taking that trade, but they also will put you in either an A book or a B book. Now, this is very, very complex or complicated to understand. So, for a retail trader to understand this, so I'm just going to try to do my best. The broker connects to the market, to the original market, and has two different, or I should say the broker divides himself in two. Let's say the A books and the B books. The A book broker has clients that are winning constantly, a 90% win ratio, and using hundreds of lots. They're using hundreds of standard lots, thousands of standard lots, taking trades that they know that are going to make money. So they have clients that constantly make money. And then on the other side, this is the 10% on the A book. The other side, in the other market, is the B book. The B book is an exact copy of the A book market, but the B book is basically a copy of the original market. It is a how do I explain it? It's like a hologram of this A book. It's an exact copy, but the broker owns the market, I guess. It's an emulated market through the broker. And the best way to put it, if the broker has a clients with 90% lose ratio, if the broker can emulate a market and put the 90% losers in that market, he will end up taking the other side of the trade and getting a 90% win ratio off of the 90% lose ratio of the emulated market participants of that B book or other market. So, in other words, if you win 90% of the time and you're using hundreds of standard lots, you will be plugged into the marketplace itself. If you're not, and you're a retail trader, like most of us, you will be B-booked. It may be the other way around, but just understand it like that. The broker is separated into two. Leverage is a double-edged sword. This is what I'm going to end upon. I used leverage of 1 to 50 until I became consistent. Leverage is very, very evil if you don't know what you're doing, if you can't get a good entry. And the entire concept of what we are teaching at forexcommunity.online or Forex Investors Alliance is the ability to get entries that have very, very little risk and almost instantly be placed into profit. So, leverage, why would the broker borrow you? There's brokers that have 1 to 5,000 leverage, 1 to 1,000 leverage, 1 to 500 leverage. Why would the broker borrow you 500 times more, or 1,000 times more, 3,000 times more money? Why would he do that? Because he knows you're going to blow the account. He knows that you are most likely to blow the account, and he will make that money. He will be on the other side of that trade. So they want you to blow your account as fast as possible, and then to recoup from that, they use your money that you blew your account with, and that's B-booked, to pay marketers and for marketing purposes. So these were the mind-blowing Forex truths. There's many, 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 many more, but I just wanted to keep the video short. I know you guys like shorter videos, I guess. And what I do want to end off with is forexcommunity.online. If you're not in, type it in the browser right there, right now. Forexcommunity.online. It'll link you up with our channel and a community of different Forex traders from all around the world that you can view their analysis and their output on different currency pairs. So, thank you guys for joining. Thank you for watching this video. Please give it a thumbs up, like, subscribe. Peace out.